100,000 Americans died of overdoses last year. That is a 15% increase from the year before, and it's the first time that number has reached six figures. More than 80,000 of those deaths were from opioids, including prescription pain pills and fentanyl, which is often added to illicit drugs. The head of the White House Office of National Drug Control Policy put out a statement saying it is unacceptable that we're losing a life to overdose every 5 minutes around the clock. In Washington, I'm Nathan Hager, Bloomberg Radio.
U.S. Defense Secretary Lloyd Austin says the coming weeks will be critical for Ukraine. He thanked House lawmakers today for approving a new package of aid and says he hopes the Senate will follow suit.
The United States has been able to deliver security assistance to Ukraine with unprecedented speed and resolve.
But Secretary Austin says much more will be needed to help Ukraine survive Russia's ongoing invasion. A New York judge says he is close to releasing Donald Trump from a contempt finding, but only if the former president meets certain conditions, including paying $110,000 in fines accrued for failing to turn over documents in a state civil investigation. The judge says he will conditionally lift Trump's contempt finding if by May 20th, Trump submits additional affidavits detailing efforts to search for records and explaining his and his company's document retention policies. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nancy Lyons, there in our Washington newsroom and bureau. Let's talk about Carvana, because it is down 87% this year, hitting a new 52-week low, down another 18% in today's trade alone.
Yeah, the online used car dealer trading as if the pandemic that spurred an almost 1,200% surge in its stock price never actually happened. Wall Street, though, Carol, has yet to fully adjust to that new reality, as you mentioned. The latest quarterly results from the company added to the concern, with analysts warning about slowing industry demand amid soaring inflation. To make matters worse, Carvana struck what was seen as a, quote, unfavorable financing deal to fund an acquisition. That then followed by a plan to cut around 2,500 jobs that was announced last week.
That's a lot. Hey, if you look at the analysts, there are 11 buys, 14 holds, and 3 sells. I thought it was interesting because this also talks about the story by our Esha Day. Analysts' average target on the stock has tumbled 68% this year, but at $117 is still more than triple the current price of around $36. The decline also pales in comparison to the roughly 85% collapse in the shares in 2022 amid a broader sell-off in riskier assets as really investors fretted over inflation, hawkish stance by the Fed, and so many other things. But it is interesting to see the analyst community. I'm always surprised when a stock has just tumbled and they're still like holding on.
Yeah, I mean, we talked about Disney. Yeah, that's what we talked about. They're still bullish on Disney and expecting a double-digit stock price increase over the next year. I think it was to recover.
And maybe I understand for Disney because I understand maybe some of the different. I don't know for Carvana.
This doesn't have the same track record as Disney.
No, and really benefited as everybody was scrambling for cars during the pandemic.
Yeah, let's talk a little bit about that, because it was 9 months ago that Carvana was one of the darlings of the stock market. Auto manufacturers were hit by crippling supply shortages, causing production halts, making new cars scarce. So demand for used vehicles soared as a result. That was a further boost for Carvana, and we saw it even in the inflation figures today, Carol. Used car prices down. New car prices year over year still really hot.
So kind of interesting. I do think, again, we talk about it, you and I do, about this recalibration in the economy, and I think this is part of what we're doing. Like, what is the post-pandemic economy? And we're painfully figuring that out.
news, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Take. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. 13 minutes to go ahead of the closing bell. No late day rebound. In fact, lows of the day right now for the S&P 500 index and lows for the year. Right now, the S&P is down 64 points, a drop of 1.6%. NASDAQ, though, down 3.2%, lower by 377 points. The Dow right now down 306, a decline there of 1%. 10-year's up 17 seconds, 10-year yield 2.92%. Stocks are slumping amid intense volatility after data this morning showed inflation will remain high for quite a while and a challenge for the Fed's task of taming price pressures without causing a recession. Again, the 10-year yield 2.92%. Stocks are selling off. Spot gold up 0.9%, $18.54 the ounce. Bitcoin down 5.5%, 29,262, and Coinbase plunging now by 26.7%. Crude up 5.5%. West Texas Intermediate 105.24. Lots of earnings after the closing bell today, but perhaps among the closely watched, the most closely watched will be the Walt Disney Company, down now by 2.4%. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
Thank you so much for that update, Charlie Pellet. It's 3:48 on Wall Street.
The following is an editorial from Bloomberg Opinion.
Learning the right lessons from the pandemic is essential, but jumping to the wrong conclusions will only add to its costs. In trade policy, this is no hypothetical danger. It's happening. Even before COVID-19 struck, support for liberal trade was faltering in many countries. 2 years of virus-related disruptions have further highlighted the risks of relying on extended supply chains. Now some suggest the world has entered a post-globalization era. This kind of thinking threatens slower growth, lowers real incomes, and diminishes prospects for every kind of international cooperation. The risks and downsides of trade aren't imaginary. Policies are needed to mitigate them, and governments have too often neglected this task. But it would be hard to exaggerate how misguided it would be to turn trade against itself. Globalization still works, and the world needs it more than ever. This editorial was written by the Bloomberg Opinion Editorial Board. I'm David Shipley. For more Bloomberg Opinion, please go to Bloomberg.com/opinion or OPI and Go on the Bloomberg Terminal.
This has been Bloomberg Opinion.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
You drive me crazy.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
on Bloomberg Radio.
All right, folks, just about 10 and a half minutes left in the trading day on this Wednesday, and we're pretty much at our lows of the session. Charlie, of course, breaking down those numbers. Really feeling the heat is, once again, those tech names. They're down 3.3% on the day when we talk about the NASDAQ.
Let's get into it with Austin Graff, portfolio manager at TrueMark Investments. Austin joining us on the phone from Miami. Austin, on a day like today where we do see a lot of volatility and like big moves specifically within the NASDAQ and the Dow, just wondering how you make sense of it for clients and really in terms of the macro environment.
Yeah, so the macro environment's been kind of interesting lately. Got, I would say, a bit of a changing paradigm with the Fed going from extremely easy policy to starting to tighten. And I guess the numbers today, or the CPI numbers this morning, indicated that, maybe inflation is not going to come down as quickly as people had hoped. And so this changing paradigm might be, solidifying a bit more. So you're seeing a continuation of kind of what we've seen throughout the entire year so far, where you're seeing, some of the high flyers the last few years and the growth names trading off. And you're actually seeing some of the kind of higher quality traditional names with high free cash flows hanging in there a little bit better as people start to migrate towards more valuation focus rather than a growth focus.
All right, so I'm looking at the NASDAQ 100, though, specifically. I just was quick checking on the Bloomberg terminal, and we did see a high back in November 19th of 2021, so towards the end of last year. We knew that, right? A lot of momentum. We are down about 27, almost 28% since then. I mean, does that makes sense if you look at some of these tech names. I mean, that's, almost a 1/3 haircut.
Yeah, I think that, a lot of those names were trading at excessive valuations, likely because of Fed policy being extremely easy. And I think it's kind of dangerous to sit here and say, well, the market's down 30%, maybe a single name is down 50%, so it's the time to step in and buy. I think you should really be focused on valuations and understanding what the fundamental prospects are for this business going forward, and try to pick names that have solid fundamental prospects that you can buy at attractive valuations. Valuation is kind of something that people didn't focus on when the Fed was printing money like crazy, and now that they're kind of tightening the purse strings a little bit, I think that people are going to have to start to think about valuation again. And it's not the valuation that people did kind of from 2020 to late 2021, where they would say, well, the stock was at X, it's down 20%, so it's a buy because it's at least worth X. People actually need to dig in and look at the fundamentals, the underlying companies, and figure out what those fundamentals are worth.
But
go ahead, Carol.
One thing I want to ask you, though, is it based on, how do you figure out the valuation when we're not really quite sure about what is the economy post-pandemic, right? Even the Fed and economists talking about what maybe inflation, the new kind of target for inflation, maybe it's not that 2%, maybe it's more like 4% or 5%. Like, we just kind of don't know, right?
Yeah, that's a great point, and that's why when you put together a portfolio, you want to put together names that can benefit in kind of multiple environments. And what we're seeing is a lot of those high flyer tech names that had really aggressive growth projections, we've seen them come down quite considerably over the last, call it 3, 6, 9 months. And those are probably the names that you don't necessarily want to be focusing on, because it seems like the fundamentals aren't necessarily as solid for them as many had expected. I think it probably makes sense to look at companies that can benefit from the current environment. So what's driving inflation? What's the Fed's kind of solution for inflation? So a lot of the names that we're focused on are kind of the energy and commodity names, those financial names that have automatic price increases being run through their financial statements just based on what's going on in the economy. And then on the other side of things, we're also looking at companies that have really stable businesses. So the consumer staples, the healthcare names, the utilities, that if the Fed is successful in slowing down the economy and slowing down inflation, these companies have the ability to earn attractive returns through a slower growth environment as well.
What's pretty remarkable today, and I say this because ExxonMobil is one of the top holdings in the TrueShares Low Volatility Equity Income ETF, is the news that Apple is no longer the largest publicly traded company in the world because Saudi Aramco passed. And it got me thinking about what happened back in 2011 when Apple went past Exxon. Back then, both companies were worth less than $400 billion. And Exxon is still below $400 billion. So yeah, energy has been great these last couple of years, but it was a tough road to get there, Austin.
Yeah, you're right. And so I think for the longest time, with energy prices low, it's hard for a lot of these companies to generate good returns. And in a lot of situations, they were plowing more money back into the ground, chasing low return projects. And what we've seen over the last, call it 12 to 18 months, is energy companies have kind of gotten religion on capital allocation. And instead of just plowing money into projects to grow for growth's sake, they're starting to focus on growing profitably and returning all excess capital to shareholders through the form of dividends and buybacks. And so once that trend took over, we've seen energy companies perform significantly better than they had in the past. And it's also why we're seeing a bit of a supply and demand mismatch in the energy market, because they don't necessarily have the incentive to increase supply while demand continues to increase as the economy opens post-COVID.
So is it mostly energy that you're thinking about, or just because I do wonder about if the economy becomes more troublesome, do we need to be worried about, potentially dividend cuts or dividend staying, kind of stationary? We've just got about 20 seconds.
Yeah, so you want to identify companies that have the ability to perform through the economic cycle.
Yeah.
And in some situations, we own energy names that have very attractive prospects, what we believe, through this current oil environment. And so we intend to own them through the cycle.
Okay.
But they're earning far in excess of what they're paying in dividends, so we don't think they're going to be cutting their dividends anytime soon.
All right. Good to check in with you. Austin Graff, portfolio manager at TrueMark Investments, joining us on the phone from Miami. Just got about 2.5 minutes left in the session. We're pretty much at session lows, 3.3% lower on the NASDAQ, and the S&P down about 1.7%. Coming up next, we'll be joined by our Bloomberg TV team for Beyond the Bell on radio, TV, and YouTube. We're counting you down to the close.
Beyond the Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic, Caroline Hyde, Taylor Riggs here, counting you down to the closing bell, here to help take us beyond the bell. It's our global simulcast, joined now by Carol Masser and Tim Stenovic. We welcome our audiences across Bloomberg Television, radio, and YouTube on a Wednesday afternoon where stocks open lower, but actually spent a good portion of the day higher, significantly higher. And now, as we get closer to these closing bells, Carol, they are significantly lower, lows of the day.
Yep, headed to the gate, certainly with a risk-off trade here. And if you take a look at the home builder stock, something I've been keeping an eye on the last couple of days, down another 4.7% today, down about 13% since the day after that Fed meeting last week. So we're seeing lots of pressure. We see mortgage rates, though, right now at the highest level since 2009. So those stocks definitely feeling some pain.
Yeah, quite the range in today's trade, especially when it comes to the NASDAQ 100. It was up by as much as 1% earlier, as low as 3.3%, which is what we're seeing toward the end of the day now.
Tim, I like that you brought up the NASDAQ and the NASDAQ 100, and at least here on the TV side, we've been talking a lot about some of the big drawdowns that we've had, and my latest math was showing now a 28% drawdown from some of the latest highs that we've had. Caroline Romaine, I know, was mentioning how that compares to previous drawdowns of March 2020.
Well, just to put it in perspective right now, so the drawdown rate is 27.8 on the NASDAQ 100.
Okay.
It is. The max drawdown that we had back in March of 2020 was 28.03. So we're basically just, a quarter percentage point off where we were.
And the economy looks different. But the bigger issues of a Federal Reserve hiking, I think, has been the sentiment shift that we're experiencing this time.
I think so. And sort of the big question now is sort of what stops this? What ends up putting a floor under this? And more importantly, what becomes a spring for what could potentially be the next bull market here? Are we far away from that? It's a big question that has to be answered. At least on this day here, we still seem a long way off. The Dow Jones Industrial Average going to finish the day down by about a percentage point, 326 in Dow points. The S&P 500 down by about 66 points, or 1.6% on the day. And the NASDAQ Composite going to finish the day down by about 3.2%. The NASDAQ 100 down by about 3%. And as far as the Russell 2000, not doing any better here, down on the day by about 2.5%.
Yeah, feeling pretty ugly, but still 126 names in the S&P 500 actually posting some gains, Taylor, but the bulk of it, 375 lower, 3 unchanged here.
And I know, of course, we have a great sort of headline there that Disney earnings are coming in just a few moments. Disney shares
imminent.
The lowest since May of 2020, Romaine. So really sort of a rethink about the valuations of that company as well. Quickly here, come and take a look at where we are in terms of two sectors below the S&P 500. Carol's, I try to give you sort of a good size and scope of where we are in this market. Energy, utilities, food and beverage. If that isn't screaming defensiveness, plus energy is the classic outlier, I don't know what is. That is up about 0.6 to more than 1% on the day. Down at the bottom, though, it is risk off pretty much across the board. It's media, it's technology, it's software, it's semiconductors, it's hardware, and it's auto components. That is the huge rotation out of technology, off as much as 8% or so on some of these individual sectors.
All right, we are waiting for Disney earnings, and as soon as they cross, we will bring them to you. In the meantime, some of the gainers, certainly on my radar, is Electronic Arts. We've talked about it a lot, up about 8%, top in the S&P 500 and the NASDAQ, even after the revenue forecast missed analysts, but there were some positive comments by the analyst community, and you had MoffettNathanson actually upgrading the stock with some upbeat comments. H&R Block, you talked to the CEO, we did as well. That stock up 20% in today's session, and this company boosting its revenue guidance for the full year, describing the economy to us as transitioning, but nonetheless really an outlier and outperformer in today's session. And Duke Realty up almost 8% in today's session on the deal front, top in the S&P 500, responding today, saying a $24 billion all-stock takeover by Prologis is unprecedented. insufficient, I should say. So nonetheless, that stock gaining as well.
You talked, Taylor, about the rotation outside of tech today. Let's look at Apple. Shares finishing the day down by more than 5% today. The company's stock price at its lowest level since October 15th. It lost the title of the world's most valuable company, overtaken by Saudi Aramco this afternoon. Both companies valued at just around $2.4 trillion, but Saudi Aramco has the edge there. I do remember back in 2011, the first time that Apple passed ExxonMobil to become the world's most valuable publicly traded company. The market caps of both of those companies then were under $400 billion. That ExxonMobil still under $400 billion to this day. Moderna shares finishing the day down by 6.7%. Shares lower after the company's CFO stepped down after just one day on the job. Jorge Gomez, departing after the dental supply company Dentsply Sirona, said Tuesday it was investigating the use of incentives.
That's a great story, right?
Yeah.
I mean, because it makes you wonder sort of what happened during the vetting process.
That's what Carol brought that up on our radio program earlier today. Yeah,
Right.
like, don't they do background checks on these things? But you mentioned it yesterday as one of your biggest decliners, Romaine, because shares took a tumble after the company revealed that this was happening. So, you know, it's all about when the news comes out, I guess. Coinbase finished the day down by 26.4%. Revenue came in lower than expected. The company warning that trading volume and monthly transacting users in the second quarter expected to be lower than the first.
Romaine, loving that we're on the same mind meld. I'm just going to say about that.
We are.
Of one mind. That's exactly what they say about the simulcast, don't they? Meanwhile, I'm having a look at the flight to havens. When you're looking at FX at the moment, team, Japanese yen up 0.4%. We really see a push into the Swiss franc as well, up 0.2%, even as we see continued strength come from a US dollar with a CPI print that is again ahead of expectations. Inflation pushes what the Fed has to do. We're looking at, therefore, under pressure has been the likes of, notably, the British pound off again, 0.6%. I'm interested in the fact the Canadian dollar is up 0.25%. We look at the fact that oil is trading on the higher side. That all about stockpiles, dwindling of oil. We've seen oil under pressure previously, but now actually a big ramp back higher at $105 in WTI crude, $107 on Brent. So steady march higher in commodities over the last couple of days. And even metals catching a bid. We've actually got a bit of heat happening here in the United States, so a push towards natural gas, a use of perhaps those cooling mechanisms, aircon, let's call it, so energy needs up, so commodities, a sea of green. No wonder we got inflation on our minds. And meanwhile, we once again have a move to the haven that is bonds over in Europe, Italian yields pushing down, and I know you've got the US take, Taylor.
Yeah, very similar, Caroline. It is priced higher, yield lower, at least further out on the yield curve, anywhere from 5s all the way out to 30s. You just sort of a weaker than expected 10-year bond auction because you've had yields really come down amidst all of this volatility. Quickly here, though, on the front end of that yield curve, that 2-year yield up now about 3 basis points or so to the day. A big rethink about sort of a Federal Reserve on the move, and Romaine, Disney is out.
Yeah, taking a look at those Disney shares. Disney earnings coming out, adjusted EPS for the fiscal second quarter. This is the quarter ended in March, $1.08 a share. The street was looking on average for $1.17. As far as the revenue, $19.25 billion. The street was looking for $20.11. So a miss on the headline revenue number and the headline adjusted EPS number. Let's dive a little bit deeper here into some of the segments, guys. Let's talk about Disney Plus subscribers. They're coming in actually slightly above estimates. 137.7 million folks subscribed right now to Disney Plus. The street was looking for 134.4. As far as the parks business, which is supposed to be the ballast here, revenue there did come in higher than expectations. $6.7 billion. The street was looking for $6.12 billion. And as far as the media and entertainment business writ large, they had operating income of $1.9 billion. So a little bit of a mixed bag here. Some of the headline numbers, guys, look like they missed. However, when you dive a little bit deeper, it does appear that they did beat on some of the key metrics.
And maybe some of a huge relief after Netflix, the turmoil that we've seen within the streaming space. We are hearing, of course, from Bob Chapek in that press release, talking about not only the strength of the domestic parks, but the focus on the streaming services, with 7.9 million Disney Plus subscribers added in the quarter, and total subscriptions now across those platforms exceeding 205 million. Proving that they are in a league of their own. And I do wonder if this is some relief a little bit here as we're thinking about how the streaming platform going forward. Let's bring in Geetha Ranganathan, of course, U.S. media analyst here for Bloomberg Intelligence. Geetha, what really stands out to you here in these numbers?
Yeah, so the two numbers that I'm really looking at were, number one, as you pointed out, the Disney Plus subscriber numbers, and it looks like it was a pretty big, comfortable beat there adding more than 7 million when the street was kind of looking for anywhere from 4.5 to 5. So obviously the streaming story, the growth story is far from over. And the other big number that I was looking for was parks. Consensus was at 1.6 billion in operating income. I think they came in at about 1.76. So again, a beat on that as well. So these are really the two big numbers, that we're looking for. And it looks like they beat on both those fronts.
Hey, Geeta, Carol here. We talked earlier here on Bloomberg Radio, and you said that there's kind of a good growth runway for Disney when it comes to Disney Plus specifically. So to see this outperformance compared to Netflix, like how do we kind of cross that?
Yes, I think these are two services. Obviously, they're huge, dominant streaming players, but they're at two very different stages in their life cycle. So as we know, Netflix already has crossed that 200 million mark, 222 million, but they've kind of hit the wall there. And it's still to be seen where Disney Plus kind of hits that wall. But as of right now, with 137 million subscribers, they obviously have a huge runway. Just kind of looking at all of the massive content drops that are going to come to the platform later this year. We know there are huge movies that they have in the pipeline, Marvel movies, an Avatar movie, all of which will eventually come to the Disney Plus platform. And you have a lot of overseas market expansion. So right in the summer, maybe in about another 2 or 3 months, we have them going out all across Europe, Middle East, and Africa. And that's going to give them access to about 100 million broadband households. So definitely a lot of runway left for the streaming service.
Talk to us about any inflationary pressures that we're seeing within it, Geeta. They are talking about higher programming, production, marketing, technology costs overall, partially offset by the increase in subscription revenue. So are they able to pass on to the consumer?
Yeah, I think they will be. I mean, as far as pricing power goes on the streaming service, I think, just the fact that they started off at a pretty low price point, I think gives them a lot of room, for upward price movement. But I think really the big inflationary question is on the parks business. That there are fears of both, inflation when it comes to operating expenses and labor costs. We know that labor costs make up about 40% of operating expenses at the Disney parks. But what they've done over the period of the pandemic is they have instituted so many of these operational and structural efficiencies that helps them manage attendance, that kind of smooths it out, and it really helps them staff very, very efficiently. And that's why we're kind of seeing these operating income numbers come in where they're coming in, just have so much of operating leverage now in that business. So, I think they've kind of worked through those inflationary pressures really well. Again, I don't know about recession. I think that'll be one of the big questions. A lot of the sentiment souring on the name has been because, if a recession doesn't indeed hit, then, what is going to happen to the theme park business? I think this one's going to be a little bit different. I think people have been homebound for too long. I think everybody kind of wants to get out. Parks are jammed right now, really.
Yeah.
So we'll have to see, but yeah.
Well, Geeta, let's talk a little bit more about parks, because it's remarkable that a couple years ago, if we were talking, we'd be talking, saying, investors are thankful or grateful that the company has Disney Plus while parks are closed during the coronavirus pandemic. But now, as the focus has shifted from streaming, now investors and analysts are certainly grateful that the company has parks to play on this reopening trade. So what specifics are you looking for from Chapek and company when you dive into the earnings report to really get an understanding of the pricing power that the company has in an inflationary environment?
Yeah, Chapek is a park veteran, and he has really gone all out when it comes to getting all these structural and operational efficiencies on board. 2 years ago when we were thinking, I mean, the biggest question on every analyst's mind was, is the parks business ever going to recover? Is it ever going to go back to pre-pandemic levels? The answer is it already has, and it's surpassing pre-pandemic levels. We're seeing attendance that is, even with capacity restrictions, we're seeing attendance, we're seeing demand kind of outpacing pre-pandemic levels. We're seeing per capita spending, 40% increase was the number last time. I still have to dive in and see what it was this time. But really, they're firing on all cylinders when it comes to parks, when it comes to dynamic pricing. All of this, the new changes that they have implemented is really going to drive that operating margin higher and higher. We were looking at pre-pandemic, we were looking at anywhere from about the low 20s. And now what everybody's kind of projecting is this is definitely going to hit 30%, just the way that they've kind of restructured the business.
All right, our thanks there to Geeta Raghunathan, U.S. media analyst for Bloomberg Intelligence, helping us break down Disney earnings, $1.08 adjusted EPS on the back of about $19.25 billion in revenue. But more importantly, those subscriber numbers at Disney Plus coming in above estimates, and the parks business appears to be in good shape.
Yeah, stock up 6.5% in the after hours. Geeta telling us earlier, the Star Wars Hotel, it's $5,000 for 2 nights.
Lightsaber not included.
Lightsaber not. I mean, they're doing well. All right, guys. that's going to do it for our cross-platform coverage, breaking down those Disney earnings and that stock up in the after hours. We'll see you again, same time, same place tomorrow.
You're listening to Bloomberg Business Week with Carol Masser and Bloomberg Quick Takes Tim Stenovic on Bloomberg Radio.
All right, folks, you are listening to Bloomberg Radio, Bloomberg Business Week. Right now, though, we do want to get an update on world and national news. Lots going on. Nancy Lyons on it from D.C.
Thanks, Carol. President Biden is in Illinois, where he's been praising U.S. farmers as essential to curbing record high inflation and maintaining global food supplies. Following Russian President Vladimir Putin's invasion of Ukraine, Biden says his administration will address the growing cost of groceries with new initiatives aimed at encouraging more planting and harvesting of food.
We have to keep investing in our farmers to reduce the cost, to reduce prices to consumers, and have the most productive, most efficient farmers in the world.
Biden calls today's inflation numbers unacceptably high, but he says it's now the Fed's job to combat the prices. Defense Secretary Lloyd Austin has been justifying his budget request before the House Appropriations Committee and outlining the ongoing needs of Ukraine. Bloomberg's Irv Chapman reports.
Ranking Republican Kay Granger asked Austin if the munitions going to Ukraine are being replaced in U.S. stockpiles.
In terms of working with industry to get them to open up lines and increase production, they've committed to doing that. The defense industry is leaning into this. It'll take a little bit of time, but the industry is meeting us more than halfway on this issue.
Austin said the Pentagon is keeping careful tabs on the weaponry being supplied to the Ukrainian forces. In Washington, Irv Chapman, Bloomberg Radio.
A vote is underway in the Senate on protecting a woman's right to an abortion. 60 votes are needed for the measure to pass. Those votes are not there. Senate Democrats knew the measure would fail, but they wanted all senators' views on abortion rights to be on the record. Global news 24 hours a day, on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Masser, along with Tim Stenovic in our Interactive Brokers studio. A ton of earnings. We mentioned Disney. That stock's still up about 3.7% in the after hours. That streaming number for Disney Plus certainly catching investors' attention. Subscribers, 137.7 million. That does beat the estimate of 134.4 million, and we did see parks go strong as well.
There's so many earnings to choose from.
Go?
I want to go to Beyond Meat. It's up on my terminal right now.
Killed.
Down more than 12% in the after hours. Miss on the top line. Net revenue coming in shy of the $112.2 million that analysts estimated, coming in at $109.5 million. The company still sees fiscal year net revenue $560 million to $620 million. The estimate was for $586.4 million. So the company reaffirming its full year 2022 outlook, but still missing on that top line. So not pretty.
Yeah, disappointed. So let's also talk about what's going on with Rivian, because we're seeing Rivian shares up about 2.2%. They've been bouncing around, but right now up about 2.3% in the after hours. Here's some of the key headlines. Still seeing fiscal year production of 25,000 vehicles. As for first quarter revenue, that was shy, which is why you saw the stock bouncing around. 95 million versus the estimate of 131.2 million. First quarter adjusted loss was $1.43 a share. The estimate loss was for $1.45, so just 2 cents light in terms of that. Ramping production and deliveries of EDV 700 to Amazon, which is one of their big customers.
Shares of Bumble, Carol, are surging after hours, up by more than 13%. This after the company reports first quarter revenue that came in above estimates, $211.2 million, beating estimates of $208.3 million. The company sees second quarter revenue between $218 to $221 million. That came in just shy of $224.2 million. The company sees adjusted EBITDA of $51 to $53 million, so that also coming in shy of estimates. But the stock has been getting pretty beat up, so expectations were low.
Got to mention Sonos. It is up about 20% in the aftermarket, so surging as results really offset supply constraints. Second quarter adjusted EPS, that was a beat, 26 cents a share. That's 9 cents better than the street was forecasting. Second quarter revenue was also a big outperformance there, $399.8 million. The estimate was for $351.7. So, we see different stories when it comes comes to supply chains. The company's CEO warning, though, that supply chain issues and rising component prices would continue to act as a headwind throughout the year. We're going to actually talk to their CEO
Yeah,
tomorrow.
Patrick Spence will be joining us tomorrow on these results. We got to say, Carol, for context here, the company hitting a 52-week low today, trading at $18.92. Shares are down more than 36% so far this year. That's the theme that we're seeing in this latest round of earnings, is that expectations have been low. So if we do see
some outperformance,
or
just even meeting,
or Carol, if we see some underperformance like Coinbase yesterday, if that was such an ugly report,
right,
even though we saw Robinhood,
but it got smacked.
It did.
Big
yeah,
time.
but expectations should have been low because of what we saw with Robinhood.
That's so fair. All right, but look at Netflix versus Disney Plus, different stories there. All right, listen, we want to talk a little bit more about media. We thought about that and talked about that a lot with Disney, how we view and listen to media, many options and increasingly converging. And our next guest gets that big time. Joe Kinsella is president of TV Squared. It's a global measurement and attribution platform for coverage TV, essentially measuring audiences in a converging media world. We're going to unpack that in a bit. Customers include Grubhub, Audi, BMW, NBC Universal, Roku, Peloton, and many more. And it was bought by the publicly held ad and marketing company Innovid back in February.
Joe Kinsella is president at TV Squared. Joe joins us now. Joe, how are you?
I'm very well indeed. Thank you so much for having me, guys. It's great to be here.
Well, I just want to get your takes before we get right into the analytics here. I just want to get your take on the streaming environment, because we did see that Disney beat expectations when it came for Disney Plus subscribers, shares moving higher in the after hours. Different story than Netflix. And I'm just wondering how you would characterize the environment right now, because it's interesting, like this incumbent Disney that Netflix disrupted. Now Netflix is on the other side of that, with shares down, more than 75% from its highs last year.
Yeah, AVOD is definitely the cool kid. So I think, Netflix held out as long as it could.
Explain the acronym AVOD for those people who aren't familiar with it.
Sorry, ad-supported video on demand.
As opposed to transactional video on demand, where you pay for a download, or subscription video on demand, SVOD, which is what Netflix has right now.
Right. And, they held off from bringing ads in for the longest time. And then we saw the fluctuations with the share price. And here we are. I have not had any early indication as to what the Netflix offering is going to be. But, thinking that it's probably going to be the same as or similar to what everyone else is doing. But you asked me, Tim, to describe the streaming world right now. I think I can use a very nice British term, which is bonkers. And the latest statistics that we're seeing, because TV Squared by Innovid actually measures linear and streaming, but streaming is actually now accounting for, according to the IAB, about $21.2 billion worth of TV inventory. So it's really, we've seen this massive transformation and shift to CTV during COVID.
Help me out, though. A number alone doesn't always give me perspective. So 21.2 billion in TV inventory. What percentage is that in terms of streaming?
Look at it this way, Carol. It's a $70 billion universe in the US. It's about 200 billion globally. So it's small, I would say. If you look at local television, so you think about local broadcast, local cable in the US, that is also 22 billion. And think about how old that kind of industry has been in existence, thinking about the cable companies and everything else. So if you think that CTV is now the same size as local broadcast and local cable, it's really come from nowhere. And at the end of the day, everybody is now watching TV in such a different way that we're going to continue to see this huge growth in CTV.
Joe, how does the technology at TV Squared by Innovid work? Because when you talk about the streaming landscape, it's really fractured in terms of the end user and how the end user gets that signal. Could be on a Roku, it could be on an Amazon Fire Stick, it could be on a smart TV by LG or Sony. So the data is really disparate. And I'm wondering what technology you have to be able to provide companies that are looking for this data with accurate info.
Yeah, it's a great question, and one that we've tried to solve, Tim, in software. We believe that the only way that you can solve for the challenges of the modern day advertiser is to be global. and to have a solution that is software-based that truly scales. And that's easy to say, but it's actually harder to do. What's been amazing about the recent acquisition by Innovid is that we've basically been able to kind of superpower our measurement, which is, think about it this way, Innovid has an ad server that delivers ads for the 40% of the top 200 advertisers. What does that mean? That means about 1 billion ads a day. And it means that we can take every impression that gets served and pump it straight into TV Squared and either map it to, like, who did I reach? What was the audience demo? And did they take an action? So I want you to think of this as, we've done the hard bit. We've done the stitching together of all of these different platforms. And because Innovid actually delivers the ad, we can see if it's a show that runs on Peacock, on a Roku device, on a Samsung TV, we can still see that impression. Therefore, for us, what's beautiful is there's no walled gardens and we're independent. So if you're an advertiser, everyone's calling us saying, hey, wait a second, you can see all the way through the customer journey what happened.
So, Joe, if you can see all through the customer journey as the world is reopening post-pandemic, are you seeing signs that people are done or certainly at least pulling back when it comes to watching streaming? Because you are seeing people, airports are packed, people are getting out. We just talked about Disney, the parks numbers, they were strong. So are you seeing signs of, waning interest and waning demand?
Not seeing signs of waning interest, waning demand. I think what we are seeing, Carol,
waning viewing hours, something that's showing you that maybe the time spent on streaming is going back?
Time spent is now available on so many different devices. So if you think about where we used to watch TV, we all used to sit down, even in the pandemic, it became like the good old days. We'd all sit down and watch a TV show in front of the TV together. And now what we're doing is we're watching TV like on our phones, on our tablets, on our desktops during working from home hours. So we're not seeing a slackening off in viewing. What we're seeing is cross-device everywhere. People are still watching TV, but they're watching it on their smartphone on a plane. So we've got to make sure that we can still measure what's going on, both from a ascribing value. So like, did somebody take an action? Did they see an ad go to a website? Did they see an ad go into a store? Less so that we're seeing numbers change or decline on the streaming side, more so that we're seeing full cross-device, cross-platform, because CTV is accessible literally anywhere you go, and that's the beauty of it.
All right, we're going to leave it on that note. So fun to catch up with you, and hopefully you'll come back and give us some updates on what you guys are doing. Joe Kinsella is president of TV Squared, joining us via Zoom in New York City. Just want to mention once again, Disney shares up about 2.7% here in the after hours. Beyond Meat, though, we're seeing some pressure. Yeah?
Down below its IPO price.
There you go, down 22%.
Broadcasting live from the Bloomberg Interactive Broker Studio in New York. Bloomberg 1130. To Washington, D.C., Bloomberg 99.1. To Boston, Bloomberg 106.1. To San Francisco, Bloomberg 960. To the country, Sirius XM Channel 119. And around the globe, the Bloomberg Business app and BloombergRadio.com. This is Bloomberg Business Week.
You are listening to Bloomberg Business Week. I'm so looking forward to this next guest because we talk about supply chains, problems, strains. This is a company that's been manufacturing in the United States for about 75 years.
I'm looking forward because our 3-year-old has really wide feet, and the only ones that fit him are baby New Balances for wide-footed kids. I'm serious.
That is so sweet. We're going to talk to the president and CEO, Joe Preston. He's joining us in just a moment. First up, though, a lot of earnings after the close. Over to Charlie Pellet.
Thank you very much. Disney right now, the big one that we're closely watching, up now by 2.5%. It avoided the streaming slump that hammered Netflix. Disney reporting subscriber gains for its flagship streaming service that exceeded analyst estimates, easing fears that its online TV business may be peaking. So again, Disney right now up by 2.65% after hours. Rivian Automotive first quarter revenue $95 million, estimates $131.2 million, down by 4%. Bumble shares up now by 6% in extended trading after the online dating company reported first quarter results that did beat expectations. Another down day for the Dow, the S&P, NASDAQ, perhaps putting it mildly. We are at the lows of the year right now. For the year, NASDAQ down 27.3%. The S&P this year down 17%. Today, the S&P declined 65 points, down by 1.6%. NASDAQ down 373, down 3.2%. The Dow down 326, down by 1%. Stocks fell as data showed inflation will remain high for quite some time. 10-year yield 2.92%. Spot gold up 0.8%. West Texas Intermediate crude up 5.5%. Well, as for those market valuations, Austin Graff, his portfolio manager at TrueMark Investments, he was our guest right here on Bloomberg Business Week.
Valuation is kind of something that people didn't focus on when the Fed was printing money like crazy, and now that they're kind of tightening the purse strings a little bit, I think that people are going to have to start to think about valuation again.
But what about the larger issue of avoiding a recession? Mark Zandi is chief economist at Moody's Analytics.
No one likes this answer, but we need a little bit of luck. We got to get on the other side of the pandemic, and we got to, hopefully the Russian invasion of Ukraine, fades away as an economic issue.
And we will have more coming up with Mark Zandi on Sound On, 5 p.m. Wall Street time, right here on Bloomberg Radio. Recapping 10-year yield, 2.92%. S&P down 65, down 1.7%. And that's a Bloomberg Business Flash.
All right, Charlie, thank you so much. So something we talk about, you folks know that, right? With strains on global supply chains, we're hearing more and more about companies who are thinking about or actually relocating supply chains either back to the U.S. or just putting them elsewhere. New Balance has been manufacturing in the United States for more than 75 years. They own 5 factories in New England. They just opened up a new one. They've got one in the U.K., and they are a company with worldwide sales of about $4.4 billion.
That's substantial.
Yep.
Joe Preston is president and CEO of New Balance. Joe joins us via Zoom from Boston. Joe, how are you?
And it's good to hear that we may have a customer for life there. I appreciate that.
Yeah, his feet are getting wider. I don't know if they're getting any longer. It's a funny thing with kids there. So, Joe, I'm wondering about what you're seeing right now in the market with inflation. I want to get to manufacturing in just a minute, but we got to hit on this hotter than expected inflation print that we got earlier today. To what extent are you seeing that hit your bottom line in terms of costs, and what are you absorbing, and what are you passing along to consumers? Like, where is it hitting you the most?
Well, I mean, sure, it's affecting the entire industry, and the effect early on and continues to be partially related to supply. There was a shutdown in Vietnam last year that affected the entire industry, and that disrupted supply. So therefore, retailers can't plan promotional activity. So you're seeing promotional activity in our sector down, which is raising the average selling price. But on top of that, you are seeing wages go up. You're seeing material costs that are impacting the cost of goods, and we've passed on selective price increases and will continue to pass on selective price increases. And then the biggest issue, quite frankly, on the cost front is on the distribution part of it. The cost of containers, the cost of just shipping product is just so far ahead of what it was prior to the pandemic. And so we are absorbing some of those costs, and we are passing on some of them through the selected price increases.
Well, so manufacturing in the United States is just one part of it, because the components that go into the materials that go into making a shoe come from all over the world. So where are you seeing sort of the most supply chain snarls and the biggest price increases?
Well, I mean, right now you're seeing it in oil. So the impact of oil is going to impact rubber, which is obviously on the bottom of every running shoe that's made. It impacts EVA, which is in the midsole. It impacts some of the synthetics that are in the that are in the uppers on shoes, that are in the materials of polyester, et cetera, that are made on apparel, athletic apparel. So you're seeing that reverberate throughout the entire product cost chain, if you will.
So, okay, so that's good to know. And I'm also curious about labor costs in particular, whether it's at stores or elsewhere. How are you dealing with that? What kind of increases have you seen there? And Joe, I'm also curious about if you're getting all the workers that you need to do what you need to do.
Yeah, so we just opened up a new factory, as you mentioned, in Methuen, Mass, and we've hired over 100 people. And quite frankly, we were a little bit surprised that it wasn't easy. It's not easy hiring people today, but it went a lot smoother than possible. And we believe it's because it's in proximity to our other factory up there, which is about 5 miles away in Lawrence. And because we have a long tenured associate here, there's a lot of word of mouth on whether or not you're a good employer or not. And so I think that's helped us in hiring for that facility. But certainly wages are going up everywhere, whether it's inside distribution centers, whether it's retail stores or on the factory floor.
So how much have you had to increase wages at these factories in order to attract and retain talent?
Well, we went through a process in 2020 in which we raised associate wages in our factories. We just felt it was time. Our folks in our factories had been working there and continued to work there throughout the pandemic. Actually, they closed for 3 weeks in March and opened back up and began to produce over 1 million masks in the quest to try to use our factories to make products to help the medical community. So we've seen wages increase, and we increased them again this year.
All right, we're going to come back and continue this conversation. We've got a bunch more questions because I'm curious a little bit more about this manufacturing in the U.S. and whether you're having conversations with other executives who are curious about, like, how do I do this and how do I, kind of make the transition, especially when we talk so much about globalization. We're going to come back to Joe Preston, President and CEO at New Balance Athletic Shoe, based in Boston, and that's where he is joining us via Zoom.
Yeah, I mean, I imagine that it's got to be one thing to do this years ago and have sort of this DNA of manufacturing in the U.S. versus a company that has a supply chain and factories all over the world, reshoring that.
Right, and I think about, though, as you drive around this, the country, like so many cities that are could use a boost, some kind of economic boost. And yeah, you see distribution and logistics facilities, but they could certainly see some factories or manufacturing that would certainly help those local economies. We're going to come back to him in just a moment.
In the meantime, let's get to Washington, D.C. for a check of the latest world and national news with Nancy Lyons. Hey, Nance.
Thanks, Tim. As expected, today's Senate effort to ensure nationwide access to abortion has failed. Ahead of this afternoon's vote, Senate Majority Leader Chuck Schumer expressed his concerns that the Supreme Court will overturn Roe v. Wade, as revealed in that draft opinion.
The United States, which has always aspired to expand freedoms, will take a shameful step backwards.
Schumer knew the measure would not receive the 60 votes that would be needed to discuss the bill and vote on it, but he said he wanted to shed light on where each senator stands on the issue. President Biden is spending part of his afternoon at an Illinois farm where he's been discussing the importance of farmers.
The real reason I'm here is to thank American farmers. Thank farmers. You feed America. You got us through a pandemic. And you're literally the backbone of our country. It's not hyperbole. But you also feed the world. And we're seeing with Putin's war in Ukraine, you're like the backbone of freedom.
Biden says U.S. farmers will be able to make up for the gap in Ukraine's agriculture exports of wheat, corn, and cooking oil. Biden's trip comes as the government reports inflation slowed last month, but it is still at more than 8%. Senate Minority Leader Mitch McConnell says rising prices are hurting American families.
President Biden has presided over one of the most expensive years for working families in modern American history.
McConnell says it is inflation on top of inflation. President Biden blames the cost of living increase on supply chain issues brought on by the pandemic and Russia's invasion of Ukraine. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Nancy Lyons.
All right, Nance, thank you so much. Carol Master, along with Tim Stanovic. We're going to get back to Joe Preston, President and CEO over at New Balance from Boston in just a moment. In the meantime, and I feel like this is something all leaders, heads of institutions are thinking about.
This is something that you and I talked about at Milken a lot. Nonstop at Milken. We're talking ESG here, and BlackRock's plans, most specifically, is the news we're covering today. BlackRock plans to raise $1 billion to invest in companies owned, led, or serving people of color. It's the latest example of the financial industry moving to address inequality. Carol, the initiative has already gathered more than $800 million. It's set to focus on businesses and projects that serve Black, Latinx, and Native American communities in the U.S., New York-based BlackRock said in a statement today.
All right, so interesting. So initial investors in the BlackRock Impact Opportunities Fund include PayPal Holdings, Anthem, and Costco Wholesale. The fund will make direct investments across asset classes, including private equity, private credit, infrastructure, and real estate, which is really how PE rolls.
It is. This was exactly the topic of my panel at Milken. It was private capital as a tailwind for social impact. So the argument there is that a lot of the LPs, the limited partners that invest in private markets, whether it's private credit or private equity, are pushing. I mean, we're talking pension funds here, we're talking endowments. They are pushing for more transparency. They're pushing for more ESG when it comes to the companies that the PE firms and the private credit firms invest in.
Because ESG metrics and regulators are increasingly looking at this, and that you think you're making an ESG investment, and it's like, well, wait a minute.
Yeah, well,
there's
not necessarily a broad definition or some sort of broadly accepted definition at this point. You do have a handful of big companies that have signed on to sort of this
initiative,
initiative, yeah, but it's not everyone.
To do XYZ.
Exactly, and it's much more stringent in Europe.
Although one of the investors on one of the panels I did said that, is there something to be said that you make an ESG investment in a company that doesn't look so ESG, but they're transitioning to those ESG goals?
An energy company.
Exactly, and so should they be considered or included as they make that change? All right, we're going to get back to Joe Preston, CEO of New Balance. He's joining us from Boston in just a moment. We'll get back to him. You're listening to Bloomberg Business Week on Bloomberg Radio.
updates, headlines, and breaking news 24 hours a day at Bloomberg.com, the Bloomberg Business app, and at Bloomberg Quick Tape. This is a Bloomberg Business Flash.
From Bloomberg World Headquarters, I'm Charlie Pellet. Busy after the bell session for earnings. Plant-based burger maker Beyond Meat tumbling in late trading after delivering first quarter revenue that missed Wall Street expectations. Shares are now down by 23% and also below the $25 price set in the company's 29 public offering for the first time. Disney shares, they're up now by almost 2% after avoiding the streaming slump that hammered Netflix. Disney reported subscriber gains for its flagship streaming service that exceeded analyst estimates. Rivian Automotive shares, after hours, they're down now by 3%. It did say it accelerated production and stepped up sales in the first quarter, keeping the electric pickup truck maker on track to deliver 25,000 EVs this year. Bumble shares, they're trading higher after hours by about 12%. That's the online dating company. It did report first quarter results that beat expectations. Stocks slump as the Treasury curve flattened after this morning's CPI report. 10-year yield right now 2.92%. The S&P down today 65 points lower, down 1.6% for the year. Low of the year now down 17.4%. Nasdaq down 3.2% today. The Dow down 1%. 10-year yield 2.92%. Gold up 0.8, 18.52 the ounce. West Texas Intermediate crude up 5.8%, 105.57 a barrel. I'm Charlie Pelleton. That is a Bloomberg Business Flash.
It is indeed. All right, Charlie, thank you so much. I want to get back to our guest, Joe Preston, still with us, President and CEO at New Balance, based in Boston. That's where he joins us via Zoom. Joe, thanks for sticking around. When you see the struggles that we've had with supply chains during the pandemic and still coming out of it, like, what do you think are the big, smart macro discussions we need to be having right now?
I think we've all learned through COVID that early on how the country was not prepared and we were not controlling our own destiny. We didn't have manufacturing facilities for just simple but basic protective equipment for our medical community. So just prior to COVID, we came up with this philosophy about controlling our destiny, and it was all about getting closer to the consumer. And we fundamentally believe that domestic manufacturing allows us to get closer to the consumer, to detect changes and trends, and to allow us to respond quicker. But it is challenging. We're the only athletic footwear manufacturer that produces here in the U.S., and so the supplier base is limited. And so there's a need for additional incentives for suppliers to come back on to support a community so that domestic manufacturing can prosper.
You've been at this company for a long time. I think you joined it back in '95, if I'm correct.
Okay.
So, I mean, this whole retail industry continues to change significantly. What have you seen in the, your arc and just even the arc of the last couple of years in terms of increased digitization, in terms of how people shop, where this kind of retail world has gone? And there's so much competition. There's new upstart brands. You guys have been around for a while, but there's a lot of selection for consumers out there.
Yeah, well, when I joined the company was 150 million, and today we're 4.4 billion. So I've seen a lot of change for us here in the U.S. in how we have grown around the globe. But retail has gone through a complete transformation, and it's really been driven by the digital revolution. It's putting the consumer completely in control of when they want to shop, how they want to shop, and where they want to shop. And it's up to brands to make sure that they are up for that challenge. And that's where the whole DTC element has come in. For us as a wholesaler, we have trade partners all around the globe, really strong partners, decade-long relationships with them. But at the same time, us selling directly to the consumer makes us a better company. We understand the trend better, and then we're able to better service that consumer and also service our wholesale trade customer.
Well, speaking of trend, I got to ask Joe. I'm reading an article in Glamour as I was prepping for this. It was from March.
He reads it all the time, Joe. Don't let him kid you.
But it's about just the fashion associated now with New Balance. It says that recently 70,000 customers waiting in a virtual line to get their hands on a pair of New Balance's puffed up low-top basketball sneakers, the 550. I'm wondering, how you went from being, with all due respect, when I was growing up, basically shoes for dads, to becoming really cool, sought after in New York City and around the country.
Yeah. Well, we went through a real growth phase in the 90s here in the U.S. We grew from about 150 to almost $1 billion. And we captured a young consumer, a young college kid, and that consumer just got older with us. And that's consequently that same consumer today that's now wearing the dad shoes, if you will. But as we expanded around the globe, one of the things that I think allowed us to get younger was when you went into beyond Western Europe, but when you went into North Asia, like into Korea or into Taiwan, there are no major retailers there. So you need to go in and open up your own shops. So it allows you to tell your story and to express it in ways that you're not able to do it when you're only getting a small portion of a retailer. And that allowed us to get the brand younger. We also have a tremendous heritage in running. Our heritage is this running brand, if you will. So people look at that authenticity, which we can bring to our lifestyle business. But really, the intersection of sport, fashion, and fashion is that there's so much energy there in the middle. And that's an area that we believe our brand can resonate. And that's where we're seeing a lot of energy. And that's an example of it. That
I have to say, I see it with my 19-year-old. I mean, she spurns heels, but wears tons of sneakers with everything, dresses, you name it. Like that is what, and considers it high fashion, and she looks kind of cute. What's interesting is, though, if I look at something like a Nike, Joe, they're projected to have something like 47 billion in sales this year. You guys are about 4.4, I think I mentioned, or so. Is there something, do you want to be a lot bigger, or is there something in being a great player, even if it's smaller in size, that there's an amount of flexibility or nimbleness, or being nimble, that you like in this position?
We think there's opportunity for us to grow, but we're not trying to be the biggest brand, but we do want to be the best brand. The brand that consumers come to us, that athletes look for us for on the pitch, whether it's on the soccer field or on the basketball courts or on the baseball diamonds. And certainly when people look to us from a lifestyle standpoint, they can look to our brand. And if you look at our brand, the elasticity that we have, from the kids that you mentioned earlier to the dad shoes to young kids that are queuing up for our latest product releases, the elasticity of our brand may be greater than any other brand in our industry aside from Nike.
What is the biggest area for growth for you right now, of those areas that you mentioned?
Well, we believe there's a tremendous opportunity for us to continue to grow our running business. It's a core part of who we are. We just recently re-entered basketball. New Balance was the first player to sign a NBA player to $1 million contract. That was James Worthy back in the late 80s. And then we just got out of all endorsement for a number of years. We got back into it about 6 or 7 years ago. So we're now in baseball. We have about 30% of major league players wear our product. We have a number of NBA players. We have a number of top soccer players, or global football players, as they're called. And so we believe that performance imagery that we have. We also have Jack Harlow, who's one of the hottest rappers out there today. So this mixture of athletes and music is providing energy, and we think it can drive our performance business and drive our lifestyle business.
Joe, really quick, 10 seconds. You're private, been family owned. Do you stay private, or do you plan to go public in some ways? And really quickly.
Private, all the way.
There's certainly a lot of private capital out there that if you need an assist, right? Such a pleasure. Hopefully we can get you back and get an update maybe a little bit later on in the year. Joe Preston, President and CEO at New Balance, joining us via Zoom in Boston. I love talking to these types of companies.
Private companies so hot right now. I mean, Elon Musk wants to take Twitter private.
Right. And we
don't have to worry about those quarterly earnings.
Coming from
family
Milken,
control.
Right? Everybody's talking about private capital. There was tons of money out there to put to work. All right, that's going to do it for the Wednesday edition. For Tim Stanovic and the whole Bloomberg Business Week team, I'm Carol Massar. Have a good and safe evening.